Hello, I'm Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're going to be discussing the key investment trends that played out in the second quarter of 2024. Joining me to provide his expert insights is friend of the pod, Sam Benstead. So Sam, to kick off, could you give us a run through of how markets performed in the second quarter?
Of course, yeah. So it's been a really good 3 months actually for markets. So the FTSE All-Share, including dividend reinvestment, is up 3.7%. The S&P 500 actually delivered the exact same return for investors. And the MSCI World Index rose 2.4% over the past 3 months. And that marks a continuation of a really good year for investors. So year to date, US shares up about 16%. About 13% for global shares and 7.5% for UK shares. So with inflation now down at 2% in the UK, investors have made a good real inflation adjusted profit. And you can even get 5% on your cash at the moment. So all things look very good for investors at the moment, and it's been a good 3 months and a good start to the year.
So let's move on to how investment trusts and funds performed. Let's start off with investment trusts. So Sam, there were a couple of specialist investment trusts that really bounced back. Well, not quite bounced back. I mean, I think over longer term time periods, they're still quite deep in the red. But for investors that had the foresight to buy at the start of the second quarter, they've made good returns. Could you run through which ones perform well?
Yes, there's been some standout performers, but like you said, you would have to got your timing spot on to have made money in these trusts over the past couple of years. So one that stood out for me over the past 3 months was Gresham House Energy Storage, which made investors 68% over 3 months. So if you time that correctly, you are doing very, very well. But actually over 6 months, it's down 35%, and over 1 year, down 49%. And it's been under pressure for cancelling dividends. Another interesting story in the investment trust world has been Hypnosis Songs Fund. So it's been under pressure recently. So this is an investment trust that owns the rights to music and then generates an income from that and returns it to investors. But it's had to write down the value of its holdings and also cancel dividends. But anything that falls very quickly also could rise very quickly. And there's been interest from private equity groups in buying its assets. So the 3 month return on that has been 48%. And then one other investment trust I would highlight is Molten Ventures. So this is a venture capital trust, so invests in unlisted, exciting, but often quite volatile and unproven technology shares. So it had a very good past 3 months, up 54%, and it's doing well over the past year or so, but actually longer term, this part of the market has been out of favour.
The thing to bear in mind with those specialist investment trusts is that they are high risk. I'd view them more of a short-term punt, and I'd look to limit my exposure. And also bear in mind that with specialist strategies, they can't half blow hot and cold as conditions change. So it's important to keep a very close eye on performance and act accordingly when it looks like it's going to be a more challenging period for the way in which those investment trusts invest. In terms of funds, Sam, there have been a couple of key trends during the second quarter. One of those is that technology continues to perform well. Could you firstly run through that?
So tech, as ever, is doing fantastically well. And we've heard about this for about 18 months now, since the launch of ChatGPT and all this excitement about AI. But what's gone up over the past 18 months actually continues to do really, really well. So one of the top funds, and it's one we see regularly on our most bought lists, was the L&G Global Technology Index Trust, which rose about 14% over the past 3 months. I think year to date it's up about 30%, so really spectacular returns there. And that's not the only technology fund doing well. So Alliance Technology Trust has returned about the same amount over the past quarter. And 2 tracker funds as well, 2 ETFs, are performing very well. And one of those is the iShares S&P 500 Information Technology Sector UCITS ETF, and another is the X-Trackers MSCI USA Information Technology ETF, both up about 14% over the past 3 months. And linked to that as well are 2 ETFs tracking the Taiwanese stock market. So Taiwan Semiconductor Manufacturing Company, TSMC, is a huge part of that index, and that returned 20% over the past 3 months, which drove those ETFs up about 13% each. On these tech funds, as ever, can be very volatile and actually have become very concentrated at the moment. Companies like Nvidia and Microsoft and Apple are huge parts of those benchmarks. So that's why it's done so well. But a downturn in the AI boom or some poor earnings from one of these companies could easily trigger a sell-off.
Just to add a little bit more on what you just said there, Sam, the L&G Global Technology Index Fund has been a great performer, particularly since the start of 2023. Investors seem to be hoping and banking on the strong performance for technology, and particularly the largest technology companies, to continue. The Legal & General Global Technology Index Fund, it was the most bought fund in June. And as you mentioned, Sam, it's become more and more concentrated. In terms of its top three holdings, Microsoft accounts for 16.1%, Apple accounts for 14.7%, and Nvidia accounts for 13.9%. And as you mentioned, Sam, the performances of those three companies have a big influence on the overall returns for that index fund. So it's really important to look under the bonnet when investing in a index fund that's tracking a technology indice and understand how much concentration risk that passive fund is exposed to. A very quick snapshot is just simply looking at the top 10 holdings. Another trend that we've been seeing, Sam, is that the UK stock market has been performing well, and it's been a pretty broad rally since the end of last October. Large, mid and small cap companies have all performed well in aggregate. In the second quarter, are there any funds that stood out for you?
Yeah, that's right. So the all shares up 4% over the past 3 months, but under that story, if you do some more research, you'll find that actually it's the UK smaller companies sector which has really done well. So 3 funds stood out to me, all returning about 15%, and those were the TM Crux UK Smaller Companies Fund, the Schroeder UK Smaller Companies Fund, and the JP Morgan UK Small Cap Growth and Income Investment Trust. So why have these smaller companies been doing so well? Well, these firms are normally linked to the health of the UK economy, and that's linked to interest rates. And I think with the perception that interest rates are about to fall, maybe in the August Bank of England decision, that is good news for these companies that are quite closely correlated to the economy. And the other thing I would say, and it's something we've covered quite extensively over the past couple of years, is that UK smaller companies are really cheap, and they actually trade at a valuation discount to their larger peers, which is unusual because normally you pay a premium for growth, and the perception is that smaller companies are growing faster than larger companies.
And we've, of course, heard from a number of UK fund managers that have been interviewed on this podcast how cheap the UK stock market is relative to its history and relative to other regions. But despite the fact that there has been this rally since the end of last October, UK retail investors, they're not buying the UK. They're still waiting. I think they're waiting for a sustained period of performance before they increase exposure.
And I just add to that with the election result and 5 years of hopefully the same government now, that should increase confidence in the UK economy and UK stock market. Investors love certainty, and I think with the last government there's been so much uncertainty that actually a lot of overseas buyers have been reluctant to dip their toes into the UK market, but that now could be changing.
And the final trend in terms of fund and investment trust performance as well is that India continues to impress. Sam, could you explain what the key reasons are behind India performing well?
Yeah, India just keeps going from strength to strength, and the market has hit new all-time highs, and anybody who backed India about 18 months ago has made a lot of money and made a great decision. So just some of the winning funds first over the past quarter. Stewart Investors Indian Subcontinent Sustainability is up 15% over the past 3 months, and Invesco India Equity about the same amount, and Aberdeen Indian Equity and Equality Indian Subcontinent also up about that much. So why is India doing so well? I think over the short term, it's about politics. So the Prime Minister, Narendra Modi, has been re-elected. So that's a third term for him, and he's a market's favourite. Democracy generally in the giant country is seen as good news for investors, especially when you compare it to China. And they've got about 1 billion people there as well. So very young, dynamic population, democratic system. Companies are incentivized to move manufacturing and investment away from China. India seems like a great option there. And really strong economic growth as well. So lots in its favour. The pushback is that valuations are now quite expensive, but still lots of positive stories coming out of India at the moment.
There was a bit of volatility in the Indian stock market following that general election result. As expected, Narendra Modi won a third term in office, but he lost his parliamentary majority. And this did cause a bit of a short-term sell-off in the market. But the comments I've seen from fund managers that invest in India is that the long-term story is unchanged. And as you mentioned, Sam, the attractions of investing in India are due to its favourable demographics. It has a very young population and a growing middle class. Half its population are under the age of 25. And also political risk is considered to be lower in India than other emerging markets. And the surprise election result in Modi losing his majority has not changed that view. So we've run through some of the strongest performers in the second quarter. Sam, which types of funds and investment trusts didn't perform well? Which were the biggest losers?
So like in the winners, it's often the investment trusts that are, they show the biggest movements in the prices over short periods. And one of those was JP Morgan Emerging Europe, Middle East and Africa, which is the former JP Morgan Russian Securities Investment Trust. So over that quarter, it returned a negative 23% return for investors, and that included a 30% drop in April when news broke that JP Morgan was in a court battle to stop a Russian bank from seizing its assets. Another really poor performer was Regional REIT, which fell 22.5% over the quarter. And this property investor was facing concerns about solvency and was also turning to markets to raise more money. Another sector that's done not very well recently is Latin America. So this included generalist funds such as BlackRock Latin America, Schroeder Latin American, Barings Latin America, and the iShares MSCI EM Latin America ETF. Those all fell about 14% over the quarter. If you wanted to dig a bit further into the sector, you could look at Mexico and Brazil, which also performed poorly, with tracker funds in those markets returning about 15% negative returns. So why is Latin America doing so poorly? Well, the region is heavily dependent on mining and oil companies, and commodity prices aren't doing so well, with the exception of gold and silver at the moment as inflation subsides. Another area to highlight in terms of poor performance over the past quarter, and this contrasts with Taiwan doing so well. So the HSBC MSCI Indonesia UCITS ETF fell 14%, and the X-Trackers MSCI Philippines UCITS ETF fell about 11%.
And the thing to bear in mind when you invest in a fund or an investment trust and it's a big percentage loss over a short time period is that it does require bigger percentage gains to recover. For example, a loss of 10% requires a gain of 11% to break even. A loss of 20% requires a gain of 25%. And then a loss of 33%, it requires a gain of 50%. And a loss of 50% requires a gain of 100%. So that's something to bear in mind when you're considering what to do next, when you've invested in a fund or investment trust and it's had a really bad period of performance, particularly if you've got off to a bad start. So Sam, let's move on to the bond market. So firstly, could you give an overview of how the bond market performed in the second quarter? Yeah,
so it's been a quite sleepy quarter for bond markets, but actually that's not such a bad thing. You're not really invested in bonds for superstar growth, and you definitely don't want to see yourself losing money there. So I looked at the returns of the typical sterling corporate bond fund over the past 3 months, and it was basically exactly flat. The same was true for the strategic bond fund sector in sterling as well. And then high yield funds did a little bit better, returning about 1.5% on average. And all this includes the reinvestment of any income generated. So reflecting those calm bond markets, gilt yields didn't move too much. So the 10-year gilt went from about 4% to 4.2% over that 3-month period. And a lot of this is linked to inflation and politics. Everything seems relatively calm at the moment. So if you're looking at the bond market, I think there's still attractive returns on offer there. So about 4% income from gilts and about 5.5% income from sterling corporate bonds.
So while it's been a sleepy quarter for the bond market, Has there still continued to be strong appetite for bonds amongst our customers, particularly for gilts?
Definitely. So I did some research this week which looked at the growth in fixed income on the platform over the past 2 years, and the figures were really extraordinary. So gilt assets have gone up 21-fold. So that's the money invested in gilts has gone up 21-fold over the past 2 years. And the fixed income generally, so that includes bond funds and direct gilts, are up about 3 times. So from basically paying investors nothing for fixed income, the market was really overvalued, to a big sell-off as inflation and interest rates rose. Now we have stability and yields still look really attractive. And I just highlight a couple of the most popular gilts. I think it's always good to have those as a reference. So at number 1, we've got TN25, which is a gilt maturing in January next year with a low coupon. T26 is a similar bond maturing in 2026. And then the other 3 most popular gilts, if you want to search them, have the stock market tickers TN28, TR25 and T26A.
So we're going to move on from bonds to finish off by covering some investment trust trends. So in previous episodes of the podcast, we've covered investment trust discounts in some detail. So I'm just going to only briefly cover this bit off by saying that investment trust discounts versus the long-term historical averages remain high. So just to put some figures on that, the average discount across 288 investment trusts that publish net asset values was minus 17.7% at the end of May, and this is compared to minus 5% across 241 trusts 5 years ago, and those figures are according to analysis by ipso facto investor. Now, one thing to bear in mind is that the renewable energy infrastructure sector does slightly distort the picture. So this sector has 21 investment trusts on an average discount of just over 30%, whereas 5 years ago, there was only 5 investment trusts in the sector, but they had an average premium of over 10%. However, a trend I'm going to talk about in more detail is that we've seen so far in 2024, including in the second quarter, a pickup in investment trust mergers. So far this year, investment trust mergers have hit a record yearly high, with 6 completed and another 2 in the pipeline. And this surpasses the previous record of 5 mergers, which were set in 2021 and 2022. And the most high profile of those potential mergers is Alliance Trust and Witan. They are proposing to join forces to create Alliance Trust Witan, which is expected to be large enough for inclusion in the FTSE 100 index. Alliance Trust Witan, the plan is it'll adopt Alliance Trust's investment strategy of investing in external fund managers that pick around 10 to 20 of their best stock ideas. Now, both Alliance Trust and Witan, they have multi-manager structures in which stock picking is outsourced. And the reason why this potential combination has come about is following Witan's long-standing chief executive, Andrew Bell, announcing earlier this year that he will be retiring in the coming year. So this prompted Witan's board to review the company's future management arrangements. If given the green light by both sets of shareholders, and the shareholder vote is going to be in around September, this will lead to a continuation of a progressive dividend policy. Both Alliance Trust and Witan are dividend heroes with 57 and 49 years of consistent dividend increases. And also have noticed that the duo are 2 of the UK's oldest investment trusts, established in 1888 and 1909 respectively. My view is that this combination makes a lot of sense, given they both have multi-manager structures. And it makes sense that it's going to be Alliance Trust's investment strategy that is going to be adopted, given that Alliance Trust has been a very strong performer since it changed fund manager and strategy in April 2017 under the management of Willis Towers Watson. Since Willis Towers Watson took over at the beginning of April 2017 to the end of March this year, its net asset value total return was 104% against 96% for the MSCI All Country World Index. And bear in mind, that has been a very difficult period for active fund managers to gain an edge, particularly over the past couple of years, due to the dominance of a small number of US technology companies. Anything further to add, Sam, on this potential mega merger for the investment trust world?
I think it's good news. I think scale is always good. And it's encouraging to Witan shareholders that actually they're going to be rolled into the Alliance Trust management approach, which has been really, really successful. So as you say, really tough to beat the MSCI world at the moment, but it's managed to do so. The multi-manager approach is low cost, it's well diversified, and you're getting access to some top quality fund managers that actually retail investors normally wouldn't be able to invest with. So overall, I think it's a good deal. And if you're using one of those two trusts as a core global position, there's nothing to worry about at the moment.
And just a final thought from me on why there has been this increase in consolidation amongst investment trusts, which is a trend that I expect to continue to play out. Ultimately, the reason why is because there are a lot of subscale investment trusts. For a wealth manager to consider an investment trust, the assets need to be around 300 million in order to have a sufficient amount of liquidity. Of course, for a retail investor, you can consider investment trusts that are below 300 million, and some of them are potentially hidden gems. But do bear in mind that some small-sized investment trusts have higher costs, including potentially higher dealing spreads. In the past, there's been some criticism aimed at investment trust boards at being reluctant to engage in potential mergers due to the argument that, turkeys don't vote for Christmas, as, this will potentially vote themselves out of a job. But it's good to see that investment trust boards are being proactive in terms of considering mergers, and also an uptick in share buybacks in an attempt to tackle wide discounts. Because ultimately, the bigger an investment trust is, the more eyeballs will be on that investment trust, and there's more chance that the investment trust will grow and become bigger, which will, in theory, reduce costs for investors if economies of scale are passed on. My thanks to Sam, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app, and do tell a friend about it. And if you get a chance, leave us a rating or a review in your podcast app too. You can join the conversation, ask questions, and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk. And I'll see you next week.